Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss why the Fed thinks inflation is transitory. And Phil, it's so interesting to see, even though the data is coming in much stronger than expected, the markets have largely shrugged off inflation.
Yeah, that's exactly right. I mean, if we look back at what happened last week, we got really strong inflation data. We got more data about the jobs strength, and yet the stock market went up. And the interest rates, the 10-year interest rates actually went down for the week. So we've now got a 10-year rate that's back below 1.5%, having been up around 1.7%. And the stock market's back at all-time highs. So that would indicate that the market's not really concerned about inflation becoming entrenched and becoming longer term, because if it did, then interest rates would go up and that would be a strong headwind against further gains in the stock market.
Let's take a look at your next couple of charts here and dive a little bit deeper into the data that was released last week.
Yeah, so I mean, basically these charts talk to why the market thinks that we might actually have some transitory inflation. And so if you think about what happened a year ago, we had the quarantine shutdowns. We actually had deflation in a number of sectors of the economy. Hotels, airlines obviously had to cut their prices and still couldn't sell enough rooms or seats. And so you actually can see in the inflation data, we fell behind, essentially. And so what the chart on the first chart from Oxford Economics does is actually kind of gets the amount of inflation we fell behind by and puts that back in against what we're seeing right now. And you can see it does support the bubble that we're getting in inflation right now. It's called the base effect, and basically it's the rebound back as we start to see airline prices increasing, hotel prices increasing. And so we're actually seeing higher inflation now just as a catch-up. And so that's the transitory part of what we're hopefully going to see if the Fed is right. The other interesting thing is when we're looking at the top line inflation, it's been driven a lot in the past few months by things like groceries, which spiked when we were all buying groceries again, and also gas, which spiked once we all started driving our cars personally again. And both of those pressures have started to come off. And so when you look at the blue line sort of showing that those pressures have already come off, and you look at consumer expectations, which are now quite high, typically what you would see is with the pocketbook items that we see every day, like groceries and gas prices coming back down, people's expectations will come back down as well.
And Phil, in the last couple of charts that we have here, we can certainly see it translate into manufacturing input and as well as wages.
Yeah, so this is the flip side, isn't it? It's the fact that when you talk to corporates at the moment, they are saying they're seeing input price inflation. They're seeing the cost of ports and transport going up. They're seeing commodity prices going up, and they're having trouble hiring people without paying higher wages. And so this is the flip side. And this is the risk, especially as wages start to go up, because wages are a bit stickier and they make costs rise for the long term. So, you know, if the wages rise, then the cost of all the goods that are being sold have to kind of rise to keep margins the same. And that could, like what we call a wage price spiral, could lead to longer term higher levels of inflation. That's when we start talking about interest rates being higher for longer later, and a bit of a headwind to the recovery in equity markets.
And I think that's what the question is, or where it's confusing for me, at least, when they talk transitory. You don't raise wages, then go back and take them down. But I guess, Phil, maybe the Fed thinks that there's so much demand right now. We know that there's not enough supply, but perhaps in Q4, Q1 of next year, that supply is going to come back into the system and naturally balance out the supply and demand picture, which kind of takes the onus off of them having to do anything with rates. Do you think that's what they're thinking?
I mean, there is definitely a huge amount of people that are still not back in the workforce. By different measures, 5 to 7 million people. So even though the inflation rate's back down to 5.8%, there's a lot of people that dropped out of the workforce. A lot of people said they retired early. A lot of women dropped out because they need to look after the kids that still aren't back at person school. So there is definitely potential supply of labor to come back into the workforce. I guess the big question for you and me is, will that supply be enough to pull wages back down? Or is it going to be too little too late, and all the stimulus that's in the system more than covers the GDP gap? Are we going to have a little bit of a spike in prices going forward?
All right, Phil, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.